Welcome back to the deep dive. So today we're jumping right into a really interesting case study, one that sort of epitomizes market contradiction.
Mm.
How does a major industrial forging company, and we're talking about Krishna Forgings Limited, RKFL, find itself navigating this sharp, pretty painful margin collapse,
Hmm.
while at the same time planning a truly massive, really aggressive capacity expansion? It almost feels like we're looking at two completely different stories here, one of crisis, one of, well, hypergrowth.
It really is a profound study in tension, isn't it? And that tension is exactly why we dove into this particular set of sources, the latest conference call transcripts, bits from the annual report, analyst notes. We really need to try and reconcile the acute financial pain they clearly felt in FY 2024-25 with this seemingly, bulletproof forward strategy they're laying out.
Yeah, so our mission today is to cut through all that data, maybe some of the management spin too, and really understand the real story behind these conflicting numbers. We'll be looking at everything from, falling steel prices, geopolitical risks, right through to some, frankly, astonishing governance details that should probably make any stakeholder pause for thought. Okay, let's kick off with that headline financial tension because the numbers themselves are, well, they're pretty jarring when you put them side by side. If you look at the top line, their net revenue actually grew. It was up 3.86% in FY 2024-25, hitting over, what, 3,634 crores?
It sounds okay on the surface, right?
Exactly, sounds decent. But the shocker is really the bottom line, specifically the EBITDA margin. It just saw this massive 5-point drop. Fell from almost 22%, 21.90% the previous year, all the way down to 16.81%. I mean, that level of compression is just brutal. What really drove that severity?
Well, that margin drop, that's the acute short-term pain we mentioned. And the primary driver seems to be realization pressure, basically what they could actually charge per kilo of forging. This was particularly sharp in the first quarter of the current fiscal year, FY 2025-26. And what's interesting here is that the main culprit cited was the drop in the steel price index,
Wow.
specifically in the US market, which then forced them to lower their own realization index, what they could charge.
Right. And we actually have specific numbers for this realization hit, don't we? And it makes it much more than just sort of general market noise.
We do, yeah. Management actually detailed it on the call. The realization loss was approximately Rs 8 per kilogram on the domestic side and Rs 5 per kilogram on the export side. And when you add that all up for the quarter, the total hit to realization was cited at Rs 31.65 crores. That's not insignificant.
No, definitely not small change.
Sure.
That really puts the market pressure into perspective. Now, predictably, management tried to pivot the narrative a bit here, presenting this kind of normalized performance story. They basically said, look, if you strip out the one-time bad luck, the core business is actually much stronger than it looks.
Oh, they absolutely did. They argued pretty strongly that if you take out specific one-time events, things like increased machining costs, some currency expenses, and a notable forex loss, I think it was Rs 5 crores, related specifically to importing capital expenditure for the expansion?
Well, they say the picture changes dramatically. Their claim is that without those, let's call them temporary issues, the consolidated profitability, the PAT, would have been higher by almost Rs 40 crores. Okay, hold on. 40 crores higher. That's a huge chunk to just dismiss as, noise or one-offs. This is where my skepticism starts to kick in a bit.
Mm-hmm.
I mean, aren't those losses, the higher machining costs, the currency hit, aren't they just the cost of doing business right now, especially with global volatility? Doesn't stripping out everything that makes the quarter look bad kind of undermine the idea of accurate current reporting?
Well, that's the key question for anyone looking at this, isn't it? Management is essentially asking you, the investor, to look past the immediate P&L statement and evaluate the company based on its potential earning power once these market conditions hopefully normalize and those extraordinary expenses perhaps disappear. Their belief, clearly stated, is that the underlying demand and their capacity utilization justify looking at that normalized profit figure around Rs 57 to 58 crores. They really want you to believe the margin compression is external and temporary, not, structural.
Okay, let's transition then from that sort of market volatility to the broader headwinds, both geopolitical and domestic, that they're facing right now. What's the scene looking like domestically here in India?
Domestically, yeah, they've definitely been dealing with a softening in the commercial vehicle or CV segment. We saw both M&HCV, that's medium and heavy commercial vehicles, and LCV, light commercial vehicles. Both declined. It was about 4% and 3% year on year, respectively, in FY25. Part of that was apparently due to delayed financing around elections and just a general bit of economic slowdown.
Hmm.
What's encouraging for them, though, are what they see as clear signs of recovery emerging now. This seems to be largely driven by infrastructure growth projects kicking in and also key government initiatives like the PM-EBA SOA scheme,
Yeah.
which is boosting demand for components needed for electric buses.
Right, okay, so if that's the domestic complexity, the international situation adds this whole other layer of sharp, pretty unpredictable policy risk, doesn't it?
It really does. And what's fascinating here is just how quickly global policy shifts can translate into a direct hit on the balance sheet. You've got the world economy facing, well, quite a bit of policy unpredictability. There's been this notable surge in tariff announcements, particularly from the US, which then triggers, inevitable retaliatory measures from trading partners. This kind of sudden shift, this uncertainty, is why global organizations like the IMF are projecting a general moderation in global growth overall.
And RKFL finds itself right in the crosshairs of those U.S. tariffs.
Mm.
How badly did this geopolitical risk actually sting them financially? Do we know?
It was significant. They stated that while only about 20% of their North America shipments go directly into the U.S.,
Okay.
those specific shipments got hit by that substantial 25% tariff. They actually quantified the financial damage. It was Rs 6 crores in the last quarter alone.
Wow.
And they're projecting a full year cost somewhere between Rs 20 crores and Rs 25 crores just from this tariff.
Right. And here's the management gamble, or maybe their confident prediction. They publicly stated they expect those additional tariffs to go away soon. Isn't that a bit dangerous? Basing future guidance, and indeed this whole expansion plan, on what seems like a political hope rather than maybe a structural trade reality. That feels incredibly risky to me.
It absolutely frames the financial hit as this sort of external anomaly that, in their view, will solve itself. It allows them, mentally at least, to focus entirely on their internal growth plan. And let's be clear, that growth plan is aggressive. It kind of demands that level of confidence, maybe even optimism.
Okay, well, let's shift gears then and talk about that strategy, because this is where the company projects just pure, unadulterated confidence. Despite the margin compression we talked about, they were sticking firmly to this near-term goal of 15–20% volume growth. How on earth are they planning to achieve that kind of scale so quickly?
Primarily through massive and pretty immediate capacity augmentation. They're right in the middle of adding an 8,000 tons press line, plus an additional 3,000 tons of other capacity. Once these new additions are fully commissioned and running, their total capacity is projected to be around 70,000 tons per annum. That's a big jump.
70,000 tons, wow.
Yeah. And their timeline is ambitious, too. They expect to have 80% to 90% of these capacity increase projects actually in place by the end of September 2025, which, in their view, sets them up for what they're calling a healthy second half of this fiscal year, FY 2025-26.
And it's not just about increasing the sheer tonnage, right? They're also aggressively targeting these sort of future-facing segments.
Precisely. That's a key part of the strategy. They're targeting electric vehicles, including hybrids, aiming for that segment to contribute something like 15% to 20% to their top line by FY 2027. They clearly see this as an essential hedge against the, eventual slowing of demand for traditional internal combustion engine components.
Makes sense.
And domestically, the rail segment is another huge push. Their joint venture for rail wheels, Ramkrishna Titagarh Rail Wheels Limited, is apparently on track to start operations by January 2026. This JV is potentially crucial, especially with the massive ongoing push by Indian Railways for high-speed rail infrastructure. Lots of wheels needed there.
Okay, so big picture. If all this capacity comes online, if they hit these new segments, what's the ultimate financial target they're setting out for investors? When do they actually see themselves getting back to that, healthy 22% margin level?
Management is remarkably confident on this point, almost bullish. They anticipate that standalone EBITDA margins should get back into that 21% to 22% range, maybe by Q4 of FY 2026, or possibly Q1 of FY 2027. That's essentially their promise for recovering the ground they've lost recently. And furthermore, they're also committed, they say, to debt reduction. With net consolidated debt currently sitting around Rs 1,800 crores, they expect to reduce that by Rs 300 crores to Rs 400 crores by the end of FY 2026. The target seems to be around Rs 1,400 crores to Rs 1,500 crores.
Okay, now here's where, for me at least, it gets really interesting. Because this incredibly aggressive expansion, this race to 70,000 tons capacity, aiming for 22% margins, is happening at the exact same time as the discovery of some, frankly, massive foundational issues regarding their governance. This is the crucial counter-narrative that maybe the casual investor might miss if they only look at the growth story. What exactly did the statutory auditors flag? This sounds serious.
It is serious, and this is the part of the story we really need to unpack carefully. The auditors raised specific and highly critical concerns. First, they discovered an inventory discrepancy in FY 2024-25. Now, this wasn't just a minor counting error. It was significant enough that they actually requested an independent external agency be brought in to conduct a proper fact-finding investigation specifically into how production and work-in-progress quantities were being recorded.
Wow. An inventory discrepancy needing an external probe. That sounds bad on its own, especially for a forging company. Why is inventory control so particularly crucial in heavy industry like this?
Well, in heavy industry, inventory control isn't just, an accounting line item. It's fundamental proof that management knows exactly what they're producing, what stage of completion it's at, how much is scrap, what they can actually sell. A serious discrepancy suggests that they might not have adequate visibility or even trust in their own factory floor reporting systems. And that really undermines the confidence needed, doesn't it? Especially when you're managing a business that's slated to expand capacity by thousands and thousands of tons.
That makes perfect sense. And it makes the next finding even more concerning then. What about their general internal controls?
Correct. The auditors didn't mince words here. They clearly stated that the internal audit system was deemed not adequate, that's the phrase they use, not adequate, commensurate with the size and nature of the company's business. And because of the uncertainty surrounding that inventory discrepancy, and also another critical issue related to management pay, the auditors issued what's called a qualified opinion on the financial statements.
Okay, a qualified opinion. For listeners who might not be familiar, what does that actually signal to the market about the reliability of this business? I mean, that sounds like a huge red flag in financial reporting.
It absolutely is. It's basically the market equivalent of waving a gigantic caution sign. It means the auditor cannot give the company a completely clean bill of health. They're essentially stating that, except for the specific matters they've detailed, like the inventory issues and the internal control weaknesses, the financial statements are presented fairly. But crucially, those specific matters they're carving out are fundamental. They cast doubt on the overall integrity and the reliability of the numbers being provided to investors and the market. It's a serious qualification.
Right. And adding, well, insult to injury, perhaps, there was also this issue of unauthorized executive pay.
Yes, that was the other key qualification. The company paid, or at least provided for, excess managerial remuneration. The amount aggregated to our 693.00 lakhs, that's almost 7 crores paid to directors for the year, ended March 31st, 2025.
7 crores.
Almost, yeah. And this exceeded the statutory limits allowed. It's now subject to subsequent shareholder approval, needing a special resolution. So think about the optics. They're spending nearly 7 crores on potentially unauthorized executive pay while the core business is facing this margin collapse, and auditors are simultaneously questioning the basic internal controls. It sends a very strange message about priorities, doesn't it?
It really does. But to circle back to the management's commitment, and to be fair, there was a remarkable, quite personal move made to try and address this inventory hit, wasn't there? To try and restore some trust.
Absolutely, and this is an important part of the narrative they put forward. The managing director made a very public commitment on the call, stating he decided to, and I quote, shield individual investors and retail investors by personally absorbing the financial hit for those inventory losses. They're achieving this, apparently, by the promoters subscribing to warrants at a high price, Rs. 2,100 per share. This is clearly management attempting to turn a severe governance issue into a powerful demonstration of personal conviction and, commitment to the shareholders, a sort of we'll take the hit gesture.
Okay. So wrapping this all up, given the sheer scale of the conflicts here, you've got this incredibly aggressive strategic vision on one side versus this pretty fundamental governance mess on the other. What's the final synthesis for you? How do you square this circle?
Well, RKFL is definitely displaying highly aggressive growth forecasts, very ambitious margin recovery targets. And these are backed by strategic capacity expansion into these future-facing markets like EV and rail. That's the very bullish investment thesis, right? But this sheer confidence is directly juxtaposed against these acute short-term financial pressures we discussed, and critically, these audit qualifications regarding the very foundation of the business. Internal controls, inventory management, executive remuneration. So the success of the whole plan really hinges entirely on perfect execution and maybe a bit of luck with external factors like tariffs and steel prices.
Right. So the key takeaway points seem clear, that short-term pain, The Q1 realization losses, the tariff pressure, that might be temporary or at least manageable. But the foundational issues, the ones about governance highlighted by that qualified audit opinion, especially the internal control deficiencies, they represent a critical layer of, well, structural risk that stakeholders just have to monitor incredibly closely going forward.
Exactly. And the core question, I think, for any long-term investor looking at our KFL right now is whether they trust those ambitious targets getting back to 21, 22% margins, hitting the EV rail goals more than they fear the current documented internal control deficiencies and governance issues.
So here's the final thought for you, the listener, to consider. Given the management's strong public commitment, even personally absorbing that inventory hit to protect investors, does the potential upside, that return to a 22% EBITDA margin driven by all this expansion, does that outweigh the documented risk associated with the current internal control problems? That's the complex trade-off you're forced to make as you digest this massive and deeply conflicted growth story.